Hello, everyone. Thank you for joining us today. David Moore, Equity Advantage, and we're going to get started in just a moment. It looks like we've only got about 20% of the people signed up on at the moment, so I guess I'm not going to punish those that are here. So we'll get started in a moment. If you're somebody that's in Oregon and you're needing real estate continuing education for today's class, it will qualify for an hour. And as usual, I've got a lot of information to get through and not much time to do it. But if you look to the right-hand side there is a spot for questions. I probably am not going to get to questions during the presentation, but we will address those questions after the fact. If you would like CE for this, please reach out to cmoore, C-M-O-O-R-E, at 1031exchange.com. Celia will get you credit hours. So thank you again for joining us today. We've got a class that I have not done. We're going to be talking about a number of transactions that we've done and sort of unique solutions to problems that maybe you didn't know had a solution. So I like to do classes where it takes a little bit of thought. And as I always state, the only dumb question is one you don't ask. So if you've got questions on some of the content, please don't hesitate to reach out later for answers on it. And like I said, it is going to be a fair amount of information to cover. There are going to be some slides in this also that we will get you the packets afterwards. It will be up on YouTube, the presentation also for later review, or if you're a broker and you have clients that you want to get information to, you can do that. But there are some slides that are in the packet that I think that are good for informational purposes, but we might not spend much time on them. So don't panic if I sort of whip through a slide. It's for a reason. It's the reason of time is time preservation. So today's title is 1031s for Today, Untold Stories. And we like to say you've worked hard for your money. We work hard to keep it yours. 1031 is tax deferral. It's not a tax-free exchange. And I guess one of the other things I really want to stress today is that it's not an all or nothing situation either. So every dollar you spend more than you want on something costs you $1. If you don't spend it, maybe it costs you 30 cents or something like that. So don't get yourself in a situation where you think, gee, I have to hit this number to be totally tax deferred or to satisfy the exchange. Like I said, it's not all or nothing. And we just want you to, really focus on where you want to go, what you've got, where you want to be in 2, 5, or 10 years, and we're going to help you get there. For those of you that don't know us, Equity Advantage is a company that my brother and I founded in 1991. We're the oldest company in this region. And our background getting into it was just working on properties, and we did something that might be looked at as flipping on the outside, but it's not, because a flip property is not an investment. It's a business, and it doesn't matter how long you own that thing. If you just buy it with the sole intent to fix it and turn it, you've held it for resale, not investment. And not only do you not get the benefit of long-term capital gains if held for long enough, but you don't have the ability to do an exchange. So we are going to talk about determining dealer status in this class. 9 points used to determine dealer status. It's this Clarkowski court case. I use that court case to figure out whether something's going to fit or not fit in the 1031 context. Also, I use that with respect to our IRA business. IRA Advantage is the sister company that handles self-directed IRAs, 401k plans. And I use it on that side when we're looking at whether an investment is a quote unquote investment or if it's a business. And it's really important to understand the difference. Even if you had a Roth IRA, let's say, and you go out and you buy a business with it, that business is going to, even you thought, gee, I bought this thing with a Roth IRA, that's tax money that's growing tax-free. You're conducting business. So you're going to be subject to something called unrelated business taxable income. So you really sort of have to look at what you've got and understand whether they're investments or business activities. Flipping properties business. So to get around that, all you got to do is go buy the property, do what you need to max out the value, season the property as an investment, and then after the appropriate period of time, which I say appropriate because 1031 does not contain a hard black and white required hold period. We're going to talk about holding periods a little bit later too. But I just want to say there's lots of things that are out there, sort of fallacies in the process. We're going to address some of them. My father always used to like to say, it's amazing how anytime you read something about something that you know something about, you know how wrong it is. So, and I think we're just really in the era of misinformation. So really take a look at stuff. If you've got questions, as I said earlier, on transactions or something you think you might want to do and you think you might be able to make it fit, give us a call. Let's talk about it. If you go back and forth via texting or emails, it can take forever, but a simple phone call, we can cover a lot of ground in a real quick period and hopefully give you some guidance on what is or is not going to fit your situation. So I just want to hit this. Yesterday, I had a couple people ask the question, and it's been sort of busy week. I'm speaking 3 days in a row this week on different things. But one of the things that comes up is we have people once again in Biden's budget. He proposed capping 1031 deferral at $500,000 per person per year. Now, that's something that has been defeated a couple times. I think it really is a bad deal for anybody that knows. But what they're looking at right now is not elimination. And somebody asked me the other day, well, what do you think is the possibility of this happening? And I mean, historically, I'd say no, it's not going to happen. But I mean, we're in a crazy upside down world. And nothing I assumed I knew, I actually am seeing the results of knowing these days. So, whether we're talking about, poor credit and lower interest rates or any combination of things, we just, we're living in an upside down world. So I don't assume things. This is a proposal that's been put out a couple times. It's been defeated because anything that stagnates market velocity. I mean, you think about if you're an investor, think of the last time you bought a property, you didn't improve that property. If you're a real estate broker, every time you sell a property, what does the buyer do to that property? So, that market velocity is just one of those things that's critical. Anything that slows that market velocity is going to be detrimental in the long run. And we've, as an industry, the Federation of Exchange Conduitors has addressed any of these proposals year after year, and showing the government how it's detrimental to them, but they don't listen. So think about one real estate transaction lost, all the people that are not being paid as vendors through that exchange or that that sale, let's say. So you think about brokers, title escrow, finance, inspectors, appraisers. You've got Home Depot, for goodness sake, all the contractors doing the work, the inspections that are being done, all that stuff's generating normal income tax, so it's going to go away with that lost transaction. If this were to happen, I would see people selling fractional interest in properties or going to smaller deals, but it's not a good thing, and it's ultimately not going to lead to increased revenue for the government. And hopefully it goes away again. But at this point, there's not a lot of people that are feeling threatened in our space about it. But that's something I'm not necessarily comfortable with either. As we stand today, there's no changes, and I don't see anything coming on the near term. The bigger issue I would see is this mark-to-market proposal. Now we, as I said earlier, we've got a sister company, IRA Advantage, that handles self-directed IRAs, 401k plans. And you think about a lot of those people. Traditionally, you've got your retirement accounts in Wall Street, investments, and obviously at any point in time, you've got a quote value you can point at to justify what that thing is. Now, you think about mark to market, and they want to tax you on unrealized gains. Well, what happens? You got unrealized losses too. So think of that in the Wall Street context, but now apply mark to market to real estate. Now, what is a piece of property worth? I mean, it's really truly worth what a buyer and seller are going to agree to. Now you're talking about valuations you're putting on property that doesn't have a sale pending. So what is that property truly worth? And think of what the cost of just administering this program would be when you start talking about applying it to real estate. It's just crazy. So hopefully that mark to market thing is something that doesn't ever see the light of day. I would expect that just the cost of administering the thing would defeat any benefit it even potentially had. So hopefully that thing doesn't happen. And then we're always looking at increased long-term capital gains tax rates. And we're also looking at different regions where they're increasing the tax rates, or, and like for example, Washington State, you've just got that statewide capital gains tax that was aimed at, let's say, Amazon and Microsoft people, and They have so far, Washington Association of Realtors has kept real estate out of that thing, but at some point we might be facing that there too. So if you look at our companies, let's say, what's happening with the deal flows with our business or where people are going on these things, we've got so much money leaving the high tax states or let's say the high rent control states, lots of rent control refugees out there. And we've just got a situation that, for example, Oregon could be up to 14.6% max state tax rate, which would be second to New York if you made 25 million or more. So, I mean, literally, you got the highest state tax level of any place in the country. Do you think that's going to be a popular place for people to go and invest? Or do you think they're going to say, well, the heck with it, I'm just going to stay out of it and go to Texas, Nevada, Florida, any of these places with no state tax? And that's what we're seeing happen. And we're also seeing those moves happen because typically those states also have more owner rights. And when you've got people moving into rental houses, let's say squatters move in, you can't even get them out. That's not a good thing for that state. And as I said, you're looking at states or even regions of states, Multnomah County, looking at their capital gains tax rate on a county or metro basis. So you really got to be aware of what's going on there and those proposals. And as we get information, we try to get it out to everybody. So why real estate today? I was taught never to bank on appreciation. Those of you that have been in our classes before know that. And so I always look at, I had to answer 3 questions. What am I going to make? When am I going to make it? How am I going to make it? If I couldn't answer the questions, I wouldn't do it. But the great thing about real estate is it's not going up. It doesn't have to go up in value to make you money. You've got that cash flow of somebody else buying the thing for you the whole time. You've got the ability to leverage it through loan. You've got interest deductions, mortgage pay down, depreciation, and at the end of the day, typically you're going to have an increased value unless you're stuck selling in a recessionary period. So you typically, if you hang on to the stuff long enough, it's going to do what you need it to do, and it's going to work out. Now, the beautiful thing about it is also that upon disposition, you've got a choice. If it's an income property, you've got a choice. You say, well, gee, I can pay the tax, or I don't want to pay the tax. You don't want to pay the tax, you do an exchange. And I'm not going to tell you that an exchange is always the right thing to do. If you've got questions on virtually any aspect of the 1031 or even self-directed retirement accounts, you can go on YouTube, check out our channel at Equity Advantage 1031s or IRA Advantage self-directed retirement accounts. You're going to see videos on all different aspects of not just the 1031 process, but you're going to even see stuff on charitable remainder trust, selling life contracts, structured sales, cost segregation, all these things, anything that we feel is going to be beneficial to the people we work with, we try to create content for. And if you've got an idea on something you don't see, or you got questions on something you don't see covered, please don't hesitate to reach out once again to see more at 1031exchange.com. We'll create some content, hopefully, to take care of it. And that way you can use it. And if you're a broker, you can get it in front of your clients too. But if you buy gold, for example, today, I mean, in recessionary times, real estate, tangible assets, hard assets are typically where people want to go. And if you buy gold, you're betting it's going to go up in value. Real estate, you don't have to make that bet. It's going to handle that stuff over time. It's not considered a liquid investment, so the lack of liquidity actually adds stability. I mean, every morning I get up. One of my buddies always used to say, never watch the news. My wife tells me not to watch the news. That's probably one of the reasons I don't have any hair on my head anymore, but I watch the news. And I do that because I want to know what's going on out there. I want to know what's going on with Wall Street. And we're going to be working on those different things that we see every day and integrating in through our business in here and into the presentations we provide. But with the real estate, you're not having to bet it's going up, all right? So, really the only reason you think about an exchange is gain. Gain is simply the difference between the adjusted sales price and the basis. So, you're going to back out from that sale, the broker's commissions, title, escrow fees, tax and legal fees, hour fees, current property tax, proration, whatever that number is, net of those costs is what you have to spend on a replacement property. So I'm going to say that again, for total deferral and exchange, you need to go across or up in value and equity. And it really has nothing to do with the gain on something. It's just the value and equity numbers, right? So, and gain doesn't have anything to do with an increased value. Gain can be triggered simply by a depreciation recapture. An asset can go down in value, or you could even lose a property to foreclosure and still have tax exposure. So you got to understand what that basic formula is just simply the adjusted sales price minus the basis what you paid for, plus capital improvements minus depreciation. And you're going to have the Fed tax typically at 20% on appreciation, 25% on depreciation recapture, the state's on top of that. And then you've still got, if you make enough, you still got the old Obamacare healthcare tax at 3.8% on top of that. So, and keep in mind, if you've bought something with the intent to hold for investment, and you didn't even hold it a year, I mean, it's still possibly do an exchange on it. And in that situation, you're looking at normal income tax on that transaction. So the tax rates could be in a situation where you're going to lose over half what you made on it if it's a short-term gain and you don't do anything about it. So I always like to say I'm just one member of a successful team of investment professionals in your life. I would say your tax people are probably some of the most important people, because before you ever go to sell something, you ought to understand what your tax liability is and figure out whether you want to pay that tax. And obviously with real estate, you still have 1031. We used to do personal property transactions. We lost personal property in Trump's tax reform in 2017. And that was sort of replaced with full expensing of a replacement item. So if you sell a jet or something else like that, you just do full depreciation on you just take it all on that purchase, and that purchase would offset the gain triggered on the disposition. It doesn't work quite as well obviously as the 1031 did, but we don't have those things for personal property. So I say that again, 1031 today only applies to real property and no personal property. So no more cars, boats, planes, artwork, all that stuff. And we used to do businesses too, can't do all that. So you offset the gains with immediate expensing of the purchase. And that's once again where your tax people are going to be so critical in your life. But with real estate, you always have that choice. And the 1031 is an opportunity cost too, because you've got the biggest problem with any exchange is time. You've only got that 45-day ID period from the state, the date of relinquishment to ID what you're going to go buy, 180 days to get the deal done. So really, people ask me all the time, when do I want them thinking about the exchange? I'd say, given a chance when they're buying the property, but at least when they go to list the property for sale, really, sharpen your pencil, understand the tax liability of it. Do you have anything else in your life you can offset the gains in real estate with losses elsewhere? You might be able to sell some stocks and mitigate the exposure on the real estate with a loss somewhere else. Once again, I want to stress that if you've got IRA or 401k funds, selling those things, that doesn't do anything, because that's all pre-tax money unless it's Roth funds. It's tax growing tax-free, but that stuff all gets taxed at normal income tax rates as you take distributions. And I really encourage people to look at their retirement account as somebody else. I say, hey, it's not yours, it's Susie down the street. And when we're looking at self-directed accounts, it's really critical that you really have to be careful that you're separating those investments from yours. And because the cost of a prohibited transaction can be very high. So these are a few examples of things that I hear all the time. People tell me, well, gee, I've been told I can do this or can't do that. And one of them that I always, if I go back 30 plus years ago, I'd walk into a presentation. I actually had hair on my head, but this business took it to me over the years. But if I go back in the early days, I'd have somebody that was much more my senior saying, well, gee, I remember when it meant house for house, land for land. It's never meant that. So 1031 from inception, the like-kind requirement is referred to the nature of the investment rather than form. So you go, houses into apartments, into dirt, into industrial. It doesn't really matter. An office building you're going to use, all those things. So any real property held for investments, like-kind with any real property acquired with the intent to hold for investment. The second one, 1031 does not require 2-year hold. A lot of times people say, well, gee, the code says 2 years. It does not say 2 years. It says 2 years if you're doing a related party transaction. So if you're swapping a property with a related party, then there's a 2-year hold and less. And even if you read the fine print, even a related party transaction, you read the fine print unless there was no intent to, avoid or eliminate tax. Now, some people might argue that 1031 in and of itself is an effort to avoid that tax. I wouldn't say that. Once again, it's tax deferral, not a tax elimination situation. The only way it goes away permanently is to do what we call swapping till you drop. When you pass away, your heirs get a stepped up basis, current market value, they could sell the next day with no tax. Now, that is something that our politicians keep looking at getting rid of also, but we can only use the laws we know exist at the time we're dealing with them. And just for future context, this presentation is taking place end of April of 2023. So if you're watching this thing and you say, well, gee, it's not that way anymore, keep in mind that this is all effective late April of 2023. All right. So I want to stress once again, there's no required hold. Somebody's pushing me on a hold period. I'm going to say a year. That's based upon 2 factors proposed a couple times, and that's the break between short and long-term tax rates on assets held for investment. So if that's good enough for the government, I assume it's good enough for us. With that said, I can give you a court case. We're going to talk about one in a few minutes where 4 months was deemed long enough under court. So anyway, number 3, there's no limit to the number of properties relinquished and or received. Now, the identification rules sort of imply differently, but that's not the case. So the identification rule that I'm going to reference right now is the 3 property rule. There's actually 3 different ID rules. We'll talk about them later, but the first one says you can ID up to 3 properties of any value. So some people take that to imply you can only buy 3 properties. It is possible to relinquish and receive any number of properties. You can give up 20 properties, buy 1, or vice versa. It really doesn't matter. The ID rules get more and more cumbersome as we add properties, but keep in mind, if you complete the exchange inside the 45 days, none of those identification rules even apply. So do what you can, time the deals to your benefit, and don't put yourself in a box, because if you put a property on the market today and somebody comes in on today's Wednesday, and then somebody comes in on Friday cash, they want to close it next Monday, you're thinking, well, gee, that was easy, that's great, it's sold already. If you don't know where you're going, you don't want a closing Monday. So I'm going to tell you, ask for whatever period of time you need to get where you want to go. Now, also something is happening, and I didn't put the big stop slide in this presentation, but back to when I want people thinking about the exchange. When you go to sell the thing, understand what your tax liabilities, consider the exchange at that point in time, and you just don't. You might find what you want before your property's sold, and that's possible. You can negotiate the purchase of it, just don't close on it until your relinquished property goes away. If you have to buy the replacement property first, you can do that via reverse exchange, but don't close on it and then call us, because you cannot legally own the new and old property at the same time. So once again, I'm going to tell you, before you buy or sell anything that you want to consider using as part of an exchange, talk to us. Don't close anything unless it's been set up, structured properly as an exchange. Because if somebody said, well, gee, your property didn't get closed in time, now we got to do the purchase, so just do a reverse exchange. So you go buy it, and then later when your property sells, you want to do the exchange. It's too late. We can't help you because you already closed on the replacement. So make sure that anything you're contemplating an exchange on, that you make sure that the exchange is structured pre-disposition or pre-acquisition. You just don't want anything closing without the exchange being structured. All right. 4, you can carry note or land sale contract, still do an exchange. Now, we've been in a pretty crazy market the last half dozen years. I haven't seen many seller carrybacks. In the last few months, I'm seeing a lot more. And the big fallacy out there is you can't do a seller carry and do an exchange. Yes, you can. There's actually 5 ways to do it. We'll talk about them a little bit later. So once again, if you close a property and you take that note and you're now getting a balloon payment on that note, it's too late to do anything about it. If you want to sell a property, carry a note, we have to be involved with that disposition. The note's going to come to us, and we're going to do something with it. We're going to talk about that a little bit later. But the main thing for you to understand is, yes, it is possible to carry paper, seller finance, and still do an exchange. All right. Another issue that's coming up a lot right now, and you might have had a situation where maybe you were looking at getting some of that mailbox money, right? Let's say you're buying into an institutional tenancy in common property or a DST. Well, those things are going to have set loan to value, and you might say, well, gee, do I need to pay down the debt on my relinquished property because I'm not going to have as much debt on the replacement, or do I have to pay off the relinquished property predisposition because I'm not going to have any debt on the replacement? Those type of conversations are coming up. And that's because of in recessionary times, you've got to reduce loan to value, and you've also got a situation your equities evaporated some too. So it's not uncommon to have to add cash to a purchase. And I'm going to tell you that adding cash to that purchase is totally fine. So debt can go away two ways. One, by going down in value, which triggers tax because you went down in value. The other way debt goes away is by adding cash to the transaction, which is always going to be fine. And then number 6, I talked about this before we got started. I'm seeing partial exchanges. Every dollar you spend on replacement property, every dollar above your basis represents tax deferred gain. If you sold $1 million property with a $200,000 basis and the $500,000 replacement property is all you wanted, yes, you are going from $1 million on phase 1, the relinquished property, into a $500,000 purchase on the replacement. But if your basis was 200, you're going to defer the difference between the 2 and the 5. So you're deferring gain on 300,000 might save you 100 in tax. You'd have exposure on the difference between the 500 and the 1 million net of closing costs. So once again, do you have losses to offset the gains? How much do you want to defer? Do you want to pull some money out, go take a trip? You can pull money out of that transaction, but it only can come out via what's called 1031-G6. So there's certain times, but if you know you want to pull some money out of the deal, you should pull it out at the close of your relinquished property, because at that point we can exclude it from the exchange. So in our assignment agreement, and we'll talk about the structure of the exchange in a while too, but one of the documents we put together when we're told go is an assignment agreement, which is the actual document allows us to assume all rights and obligations of the taxpayer as the seller of that relinquished property. If you say, David, I want to pull $50,000 out of this transaction, we're going to have in our assignment agreement, there's a paragraph in there, I think it's section 8 of it, that asks whether you'd like to retain any taxable proceeds or potentially taxable proceeds. If so, how much? You would write in, 50,000 in there if that's what you want to pull out. You're going to walk out of escrow with that 50. That 50 was excluded from the exchange, so we don't have to worry about 1031-G6 with that stuff. After the money comes to us, now we're set in a very strict situation where we can only let funds out at certain times, and we're going to talk about that a little bit later too. But I want to stress that 1031 is not all or nothing. You defer as much as you choose to defer. Don't worry about it. You're a few bucks off. Every dollar, once again, that you spend beyond what you want costs you $1. And if you don't spend it, maybe if it's long-term gain, it's going to cost you 30 some odd cents. So it just doesn't make sense to spend all this money you don't want to spend and then have, just to defer everything when it's possible. If you want to do a partial exchange, you can mitigate some of the tax with losses elsewhere, or you're just comfortable paying tax on some of that money to make your life easier. That's fine. And we have lots of, clients that are doing partial exchanges right now. This slide, if you're a broker, I'd say walk into every listing with this slide, because sometimes in today's world, if we look at section 121, the universal exclusion, that was put in place in 1997. $250,000 or $500,000 meant something at that point in time. And you think of what a house cost in 1997 versus today. So I would say that there's many people out there today on the sale of a primary residence where section 121 is woefully inadequate at deferring any tax. And I'll also say that think about this. After COVID, we've got a lot of people. You've got a lot of empty office buildings, right? Well, where are those people? They're probably working out of their house. You might have a meeting with your tax people or your lawyer, and they say, well, gee, we ought to treat that home office as a home office and take and write stuff off there and treat it as such. Now you go to sell that home, you've got a primary residence, which is section 121. The home office would be 1031 if it's been treated as such for more than 3 out of the preceding 5 years. Now, why do I say that? Because for a home to qualify for 121, you've got to have lived in it for 2 out of the preceding 5. So you can actually take a home, move out of it, and you've got up to 3 years to sell that home, still taking the exclusion, the overage would go 1031, or maybe if you don't want to move out, season the thing as an investment, maybe a QOZ would be a way to bury the overage, mitigate some of that tax consequence. But where I'm going with this, with the home office, is you've got a single asset with allocations different directions. A duplex, half owner occupied, would be another example of that. Another example would be a large property where you've got, the house and maybe the ag land, let's say. Maybe you're on a ranch or something. So maybe we're going to take the home and maybe a couple acres and treat it Section 121, and the balance of it goes 1031. But you can convert a residence into investment. You can convert an investment into residence, and there's reasons to do both of those things. And it just takes planning and time to do these things. So don't feel like you're trapped. If you've got a bunch of income properties, you probably have a nice house. And if you got that big house, your gains are probably in excess of 250 or 500. And it's funny, I've got one of my old high school friends, actually, I talked to him. He's a commercial real estate guy too, but he's got a property. His home is in San Francisco. And I've got another person involved with our company that had a rental house down there. And she couldn't, even though it was a property that had much more owner rights, she wanted to sell the property to free up some capital. She couldn't sell that property because she couldn't get the tenant out. So my buddy from high school, he's looking at gains well in excess of 250 or 500, and he's got a choice. He can put the overage into a qualified opportunity zone. By the way, if you got questions on those, type in equity advantage, QOZ or OZ or opportunity zone on YouTube. You're going to see several different series, one with Connie Rathbone, who's a lawyer in that space. And there's another whole series with another Greg Genovese, and he actually has projects underway. He's done a bunch of projects in that space. But if you've got curiosity about OZs or QOZs, take a look online on our YouTube channel. You'll find a bunch of information on those things. But if my buddy, I said, well, the last thing you want to do is rent that property. You might not be able to get people out. So in his situation, he's either going to look at the OZ, or he's going to move out of the property, move where he ultimately wants to live. And he's another one probably going to Idaho, for example. But he doesn't want to convert that property into a pure rental property, because what's his right to get that tenant out if he wants to when he goes to sell it, where he can hold the thing empty. It doesn't have to be rented to be considered held for investment. So you've just got to look at that stuff and understand you've got some flexibility, but we can convert things one way or the other depending on what your tax situation is and what you're trying to do. Questions to consider when you're looking to sell a property. Is property primary residence or investment? Are you going to reinvest the sale proceeds in other real estate? Do you know whether taxes are due on the sale of your property? Are you holding your property primarily for resale? If so, you're looking at dealer status stuff. But 121 applies to the sale of a primary residence. 1031 is investment property. If you think about things that might fall in between these two codes, would be a home that you didn't live in for 2 out of the preceding 5 years. By the way, you don't get an elective proration of the 250 or 500 in a hardship forced transaction. You can, but only in hardship, all right? And then 1031 applies that investment stuff, but 1033 might be a situation where involuntary conversion, you've got a much more attractive, if it was via condemnation, you've got much more attractive timelines over 1031 to work with. And so that's another option, another code that could be applied if it's involuntary conversion. And as far as those timelines, once again, 121 is a 2 out of 5, any 2-year aggregate period, where 1031, somebody asked me how long I'd like to see them. I'm going to hold it. I'm going to tell them a year, but that's not an absolute either. So you're going to work with your tax to be able to figure out how long is long enough. So this page just talks about this resync case. This is 4 months. People did an exchange, bought a property with the intent to hold it for investment. 4 months after acquisition, they moved into it. They were audited, taken to court, and they prevailed in court after a 4-month hold. Now, they documented the listings for rent. They documented the showings, argued hardship. They couldn't afford to keep their old home and the income property at both, so they ended up moving into the property and worked on a disposition on their home. So this thing was defended, but I'm not going to tell you 4 months is long enough. When COVID hit, by the way, we had a number of transactions where people maybe had just gotten stuff on an up leg, and now certain states, the governor said, well, gee, the taxpayer, the tenant doesn't have to, not the taxpayer, the tenant doesn't have to pay rent. And a lot of our clients are just mom and pops that have done this for years and years, and they live off the income. And if that income goes away, they've got problems. So not only just for their life, but also just to cover any debt service if it exists on the property. So we had a number of transactions where property had, let's say, abbreviated hold periods during that time because of hardship forced sales. So, if it's something where you're looking at under a year hold, you really want to work with your tax people and get their okay on how long is long enough. But if they're telling you, oh, the code says 2 years, it doesn't say that, give us a call, I'll get you some information that we'll talk about what is required and what the code does say. Dealer status. So this is the court case I was talking about, Clarkowski. 9 points used to determine dealer status. 1, purpose for which the property was acquired. 2, purpose for which the property is subsequently held. 3, extent of improvements made. 4, frequency, number, continuity, sales. 5, extent, nature of transaction of property. 6, general business activities, taxpayer. 7, the extent of advertising promotion of the property for sale. 8, whether the property is listed with a real estate broker or other outlets. And 9, the purpose for which the property is held at time of sale as opposed to time of acquisition. So if you buy a property, if you're an investor and you've been buying and selling properties for years, doing exchanges, and typically your sort of MO is to hold it for a few years, and now you've got a property that you got to turn quickly, could you do that? And I'm going to say yes. Now, it's even better if it's an unsolicited offer, okay? Now, sometimes we have people that will come in, they buy a property, get an unsolicited offer that's too good to pass up, they take advantage of doing another exchange. Well, don't get too lucky too often, because now you're establishing patterns, and now you're going to really start stacking things up against your successful application of 1031. So if you're a real estate broker, you're going to be looked at different than let's say some doctor dabbling in real estate. If you normally flip property, you can be a dealer or developer, and you can have dealer property and you can have investment property. You just got to keep those things segregated. And every time you sell one of them, pay the normal income tax on it. It's probably going to rationalize or justify other assets if you've held them for investment, your ability to do exchanges on those. But if you try to cram them all into that section 1031, it's not going to work. So the old saying with pigs and hogs, right? So you just be careful with it. Work with good tax people and go with what they say, because if there's a situation where you do get an audit, they're going to be your best friend. They're going to be sitting there next to you helping you get through that thing, and we don't want them to find out the 11th hour you did something that was weird. They didn't know anything about it until you got audited. So make sure we have a reason to do these things. If you look at these 9 points, if you got 2 or 3 against you, I'm probably not going to lose any sleep over it. But you really got to look at each property, what you're doing with each property. When you bought it, what you do with it. During the time you owned it, what you do with it. And those timelines, time is one component of it, but time is not the deciding component of it. Exchanging with related parties. Now, I did mention earlier, I said the only place 1031 has a 2-year hold is on a related party transaction. So with related parties, we say you can sell to a related party, but typically we don't want you buying from a related party unless both you and that related party are doing exchanges and both of you hold your respective replacement properties for no less than 2 years. So I'll say that again. Typically we're okay with a sale. So phase 1 is what you're relinquishing. Your relinquished property goes to a related party. That's something that's considered okay. But buying from a related party is not. You can see that stated at the bottom of this page in bold. All right. Selling to one, fine. Buying from one, not, unless both parties are doing exchanges and both parties intend to hold their respective replacements for no less than 2 years. Actually, one other comment. So on this slide, who's a related party? So you're talking about lineal ascendants, descendants, their spouses, or any legal entity owned and controlling interest by one of those. So once again, lineal ascendants, so the parents, grandparents, kids, grandkids, their spouses, or any legal entity owned and controlling interest by one of those. Those would all be related parties, and that's where those related party rules are going to apply. So basics of the exchange. I'm going to sort of go through these quickly because I want to get to the examples. And if you've done exchanges, you probably know these things. You're just going to sell a property, your properties, go out and negotiate the purchase. So the exchange is something where we're going to take your sale and purchase. You pay us a fee to structure the exchange. We don't sell investments. We don't give investment advice, but we are paid a fee to structure that exchange. And really to get it set up, you just need to include a cooperation provision in the purchase sale agreement. And that allows us to draw the assignment agreement, which allows us to do what we need to do. As long as your purchase sale agreement has a right of assignment, that can happen. I would say ideally you want to put something in there that says something about 1031, have it a contingency of the sale. Now you might say, well, gee, my state form has built-in boilerplate allowing people to do an exchange. Well, that's fine, but this code's over 100 years old and we still have people closing deals thinking they can do an exchange after the fact. So if you just rely upon some state form that says, well, you have the right to do an exchange, but you haven't let anybody know you want to, unfortunately, the number of people we get calls from the day or two after closing is brutal. Now imagine you're a broker and you're selling that person on the buy side, and now they just lost 30-some-odd% of their net equity to tax. Are they still going to be able to buy what you were finding for them? And on the other hand, if you're the investor, that stuff goes away. So you need to make sure that before you buy or sell anything, that the exchange is structured. Something's given away, something's received. And that's typically going to be in today's context where you're using an accommodator and getting the deal handled that way. So it's literally as simple as selling a property, buying a property, and we turn that thing into an exchange. 2, the items relinquished or received must be of like kind. 3, we satisfy what we call the napkin test. Finally, we've got to have continuity investing, which means the taxpayer that relinquishes is a taxpayer that receives. Now, the biggest issue with any exchange is time. Second biggest is vesting, and we'll talk about the vesting a little bit more in a minute, but the timelines of 45, 180 both start simultaneously at settlement of the relinquished property. If we're doing a reverse exchange, you've got the opposite of this happen, 180 days from the date of acquisition to get rid of what you don't want. Now, we're not talking about what we would call a blended exchange today, but it is possible. Let's say you wanted to aggregate a half dozen properties into one replacement. Well, maybe you got 3 or 4 properties sold pre-acquisition. You would have the other 2 or 3 sold after acquisition. So you'd have that exchange, you'd have a delayed exchange out of the 3 or 4 that sold beforehand, before the purchase had to happen. And then after that purchase, you'd have 180 days to sell the other 2 or 3 properties, whatever the residuals were, and they would be coming in via reverse exchange. And that total timeline could be almost up to a year's time. You've got 180 from first sale and 180 from the acquisition to sell the last sale. So it's possible with proper structuring to actually use a lot of time to get these deals done, and it's just a result of your planning and taking advantage of the timelines that are there. Now, there's no elective extensions here. If I look at, I'm talking to you from Portland, Oregon today. And if I look at the only time we ever are allowed extensions is through a federally declared national disaster. So in the Northwest, the only extensions I can remember in the 30 plus years I've been in the business is we had them for COVID, and we had them for the fires during that first year of COVID. But if we look at California, there's extensions pretty much for the whole state right now. Throughout the South, we typically have manually for hurricanes and flooding. So it depends where you are, if you can document you were impacted by that disaster, and it's something that the government has deemed a federally declared disaster, then it's possible for you to get an extension. The other thing I want to say is you've got the 45, 180 day timelines. If you're doing deals late in the tax year, you want to make sure that you complete the exchange prior to filing the return. So if you're knocking up against that April 15th date, and you haven't completed an exchange, you want to make sure you complete the exchange before filing. So file an extension so you can get the deal done, and then you can fill out the paperwork for that transaction. Property ID, 3 different rules. First, property identification rule. 1, you've got to give an unambiguous description of the property or properties you intend to buy. 2, you've got to receive substantially the same thing. If you're going to buy a piece of something, you need to identify that approximate portion to the best of your ability. All right. So that's the big thing with that unambiguous. Common address, including city, state, and zip, can be fine. If we're working with the first property ID rule, the 3 property rule, values are relevant. If we're working with a 200% or 95% rules, values are relevant. You know, they're relevant. Okay, you got to deal with them. And you know, once again, when we look at what a piece of property is worth, if you got a purchase sale pending, then you know what it's worth. Otherwise, does the property have to be on the market to be identified? No. What happens, this is another question comes up, you've only got that 45-day timeline to get things identified, and what happens day 50, one of those properties you identified gets sold to somebody else, and you say, well, gee, it's sold, I can't buy it now. So, you know, once again, 1031 G6, when I can get money out, just the fact somebody bought it, that just means it might not be on the market, doesn't mean you can't buy it. So whether things have sold and you feel they're not possible to buy anymore doesn't allow you to extend the timelines to identify anything else, and or if there's money in the account and the properties you've identified, they've all gone away and we're now on day 60, and you say, well, gee, they're all sold, I can't buy them, I want the money to go do something else. 1031 G6 doesn't allow me to get that money out. So it's really important when we get to the 45th day, you don't identify something unless you're sure you're going to buy those things. Because if you do ID something just in case, and then on day 60, day 70, you say, I don't want that thing, I want this other property, once again, I can't get you the money. So it's really important you work with that. So 3 property rule, no value requirement. 200% rule says you can ID any number of properties. Total value can't exceed 200% of the relinquished property's value. Third choice, you can exceed 3, you can exceed 200%. You got to close 95% of the aggregate value of all properties identified. Each of these rules works independently. The others, you don't have to meet all 3. 1031 G6 is why this slide exists, all right? So if you enter into an exchange and the funds come to us, you cannot receive those funds until you've purchased everything you have the ability to buy, which means inside the 45 days, you can't terminate the transaction for any reason. After that 45th day, if you didn't identify anything on day 46, we can give you the money. Now, if you identify properties, then it's a question of how you identify it. In our ID form, when you tell us go, we're going to draw up an exchange agreement, assignment agreement, escrow instructions telling escrow how to do everything. In a nutshell, the taxpayer or exchanger is going to sign things read and approved as the exchanger. We're going to sign as the seller of the relinquished property and ultimately buyer of the replacement property. If on the sale, that relinquished property, you had received, maybe you entered in the agreement last year, and now you've got earnest money that's been in your bank account, you might think, well, gee, that earnest money is going to be taxable as boot. Or if you don't want to pay tax on that earnest money, get it back into the closing so that at settlement it comes to us. Now, on the buy side, if you put earnest money into a project and you want to be reimbursed that earnest money, we can reimburse you when we go buy that property. If, on the other hand, we have your money, you want us to forward earnest money, we can do that as well. But give us 48 hours or so to get that money out, because we're going to have to draw the assignment agreement on the buy side. But that assignment agreement is going to take care of our ability to step in, but that's where, once again, it's got that blank. If you want to pull some money out, you can pull it out at that point at closing, or after you've purchased everything you have the right to buy. Now, after that property's closed, the relinquished property closes, we're going to send out an ID pack. The ID packet's going to give you the 45th and 108th day. It's going to say how much money's being held. It's going to give you the identification rules and a form to be filled in, mailed in, faxed in. Just get it to us prior to midnight the 45th day. You can change your mind over and over again up until midnight the 45th day. But on our ID form, basically what we did is, when they sort of changed the rules with 1031 G6, or didn't change the rules, but say, hey, we don't allow any money out of this exchange short of fitting 1031 G6 exactly. So in our assignment agreement, it's got the blanks where you put a description of the property or properties you want to identify. And right below that, there's a paragraph that basically says that I'm identifying these properties, but I only have the right to buy blank of them. So if you're identifying 3, 4, 5, 10 properties with the idea you're going to buy one, you would put 1 in that blank. If you're IDing 10 with the intent you're going to buy 10, then you put 10 in there. And the reason that is important is because if you ID 10 with the right to buy 1, and you want some money out of the exchange, you will have identified, you would have put 1 in that blank. You have the right to buy the 1. As soon as we buy that 1, if we're outside the 45 days, your identification stated you could only buy one, and those other properties are no longer valid IDs, so therefore we can give you the residual proceeds. Or if you didn't put that one in there, you'd have to close all of them before you get the money, which typically is going to mean that you got to wait till day 181 to get that money. And this is where the real problem is, right? Because let's say you put a property down there. When you get to the 45th day, you're either all in or you should be out at that point. Because if you get to the 45th day and just put a property in there for identification, just because, and then on day 60, you really want, you find exactly what you want, and now you say, hey, David, give me the money. I can't do that. So it's really important that on the 45th, as I said earlier, you're totally committed to completing the exchange, or you should just terminate it at that point, and then we can get you the money and you can go on your merry way. So we've got, one of the trends is a lot of people are sort of buying the 45 days to figure out what they want to do. And at that 45th day, they just say, okay, I didn't find what I want. We're going to send them a packet, ask them how they want the money. We'll get the money back out to them after that 45-day ID period's eclipsed. Notes and exchange. There's 5 different ways to work with notes and exchange. So the note, just like anything else, when you look at a note trustee, so excited about talking about this. If you look at a purchase sale agreement, all right, typically it doesn't say total cash pays. It's going to be consideration over there, right? So, a note could be that part of that. It could be all of that. You can take a property as partial consideration too. You can use anything you want as far as a stack of consideration there. But on a seller carry, we like to use known trustees. What'll happen if you want to defer all your tax on a seller carryback, the cash down payment's going to come to us, and then that note would come to us. And then we have some choices with that note. We could sell a note to a third party, and typically that discounts beyond the tax consequence. So that doesn't often happen. It doesn't seem today. I just sort of feel like those things should be worth more than they are, and the discounts should be smaller, but hey, who's listening to me on that stuff? So you can sell the note to a third party. The second option is use the note to acquire replacement property. That doesn't happen that often because the seller of the replacement property doesn't know your property, doesn't know the buyer, doesn't want that note. The third option is what typically happens. The taxpayer buys the note from us, the exchangeor does. And you're saying, well, David, why would I buy my own note? What you're really doing is substituting cash for the note. The note's going to come out to you, and think about what you're getting interest rate on the bank today. I've had people literally borrow money from a bank to buy the note. Maybe the note is sorry about that. Maybe that note is paying you 6, 7, 8%. You're selling to somebody in the weed world, it might be 20%. Where else are you going to get that return? So, selling carrying paper, it can be a good thing. Maybe that's your end game too. If it's your end game, you're not doing the note because you want to do an exchange. You're just doing the note because you want income over time. In that context, you better make sure you've got enough on the down payment to take care of the closing costs, so brokers commissions, title escrow fees, tax, legal fees, any of those costs that are going to be incurred at settlement. You want to make sure you get enough of down payment to take all that stuff out, and also understand that you're going to have tax exposure on debt relief and depreciation recapture in the year of disposition. So, I'm all for installment sales. Just make sure you're getting enough to take out everything you need to close. You're not having to come out of pocket to pay those taxes. Now, the balance of the tax repercussions on that thing, you're going to have long-term capital gains tax on the payments for the equity, and you're going to have normal income tax on the interest component. So just understand what's going on there. If you want to do the exchange with the note, again, the note's going to come to us, and we're going to do one of these things. Now, number 4 is a short-term note. Now, we've got a number of transactions that might blow up in financing at this point in time. It's changing quickly right now. So maybe it was all set and maybe it doesn't get done, or maybe you're selling a property that can't get financed. So you're going to carry the buyer for 30 days, 60 days, 90 days, whatever that short-term thing is. And so basically, as soon as that note goes to cash, so the buyer's going to get permanent financing, put it in place, take out that seller finance. As soon as that note would be ours at settlement, the refi money pays the note off. Now we have the cash to complete the transaction, totally tax deferred. So short-term notes work well. And the 5th option is simply just to do a partial exchange. Maybe if you get a large enough down payment, you do an exchange on that piece, and then you just take the note out, and you're going to pay tax on the balance of it on an installment sale basis. Few examples, and we're done. So this is an example I often use in the presentations. So if you've been on the classes, you've seen this one before, but it's something I really, think back on the slide 121, 1031, what's happening. These people, Los Gatos, California property, $3 million gain. They were going to lose, $1 million of that to tax because the exclusion only was going to cover, they were married, so a $500,000 exclusion, right? So they got referred to us by a law firm. I told them to move out of the property. They did. They held it a year or so. They went and bought the house that they wanted to live in. When they sold that property in the future, they went out and bought 24 different replacement properties, closed them all inside the 45 days. Because they didn't want to work with that 95% rule or the 200% rule. So they knew if they got it done inside the 45, they didn't have to worry about a sale fail. They defer everything. And this is a situation where they went, like I said, from $1 million tax hit to 0 taxes owed. And when it did sell, they still qualified for Section 121. They were still entitled to $500,000 exclusion. So I think it's a great example of what's possible and a great example of converting a primary residence into an investment property. It really exhibits how that can be beneficial. This is a transaction where we had a buyer wanting to use some cash and wanted to use an apartment building as partial consideration for the replacement property, which was much bigger. Now, our client, we were representing the seller of the larger building. So what happened in this situation, we couldn't convey ownership of the small units to our client and then have them sell because they would have never held the property for investment. So what happened is that just as the cash in the exchange comes to us, the property came to us. And if you're the broker representing that property on a sale, I mean, you might have had a listing for the one person, and now you'd have an assignment of listing between our EAT is an exchange combination title holder, which is just an industry term for a single member LLC with the exchange company as the member. So in that situation, the cash came to us, the property came to us, the property was then sold, and when it sold, we then had the cash proceeds and the proceeds from that sale to complete our transaction for our exchanger, totally tax deferred. So, once again, that was a short-term deal. We can't give it to the taxpayer and get it back. We want to have it go straight to us, and then at that point we're going to convert it into something that's useful. Then you could use the property and cash to buy something too, and I believe we've got another example of time where that was actually done. This is a transaction where our client gave up a 7-Eleven store, ended up buying some other property, and ultimately he wanted to go out and buy several different replacement properties. The loan to value, it was in a recessionary times, LTVs typically decrease in recessionary times. Your equity typically evaporates a little bit, as I said earlier. So he was looking at getting some more capital into the transaction. So he asked, well, can I take my IRA, my IRA, can I do a self-directed IRA and combine that money with a 1031 to go buy these properties? And the answer is yes. Typically, if we're looking at combining personal money and planned money in a common investment, we would have a choice of doing it either via membership in a limited liability company, which would be a legal partnership, or we can do it tenancy in common. But if it's part of a 1031 exchange, the 1031 prohibits partnership interest. So the 1031 required tenancy in common structure, which, by the way, is what I prefer anyway, because if you jointly own a property, you personally and your retirement account, upon a disposition, the retirement account could be in a situation where it doesn't need to do anything and it has automatic tax deferral, where your personal money you're probably going to want to do an exchange with. So I like that tick structure better. And another reason I like it better is anytime we've got let's say a limited liability company that contains disqualified parties. You're going, David, what's a disqualified party? Disqualified parties would be in the retirement world, you're a disqualified party to your retirement account. So, and your retirement account's also a disqualified party to your spouse, the lineal ascendants, descendants, their spouse, or any legal entity on a controlling interest with. Now, what's funny to me in the retirement world is that a sibling is not a disqualified party, nor are aunts, uncles, and cousins. So, we look at those things all day, every day. In the retirement side, we look at those things when we're looking at related party transactions on the 1031 side. But, really long story short, on this example, the change that would have been required to put the IRA funds into the purchase of this restaurant it would have shifted the loan from a recourse loan to a non-recourse, because the retirement accounts do not allow recourse loans. Got all recourse debt, which is typically going to be a lower loan to value and probably a higher interest rate. They're going to want to see some maybe 15% reserves too. So ultimately, our client, after investigating all it was going to take to get this thing in, and by the way, in this context, you would have identified the portion of the property being acquired via 1031, not the portion being acquired in this example being purchased by the retirement account. So it's really important, that unambiguous description. Once again, ultimately, this gentleman decided not to use both sources in the completion of the exchange, got the deal done with some other money out of his pocket, just doing it straight up personally owned via 1031. And then at a later date, we did a self-directed IRA, which he then took advantage of other market opportunities using his IRA going forward. So this is just a simple example of not having to do all or nothing. In this situation, the people gave up a $3 million property, went out and bought a $1 million replacement property. So they had a $2 million boot. And once again, what they ultimately did with the desert property is at a later date, it was converted to primary residence. Just saying, well, gee, they have $2 million in boot. How does that work? Maybe that's $600,000-$700,000 in tax. Well, yes, it is, but their basis in the property that went away, the $3 million apartment building, the tax basis, it was $250,000. So the fact that they spent $1 million on a replacement, they saved gain on $750,000, saving $250,000 in tax. So is that worth doing? Obviously. So I just want to stress that it does not have to be all or nothing. You just have to understand what the tax liability is going to be at any one point and get where you want to go. But don't sweat it out if you don't fully, if you're $10,000 off on the sale and the purchase, you're going to have exposure on the 10. It doesn't mean you lose the whole thing. All right. So really just focus on what you want, but understand and be comfortable if you're doing a partial exchange with the tax repercussions of that partial exchange. So this transaction I really like, and it sort of, once again, offers a sort of a glimpse of what is possible. So this is a sort of, I won't say it's an institutional tenancy in common property, but it was a group of regional people that we do a lot of work with. And the organizer of the investment, it went full cycle, but it was a tenancy in common ownership. And when the property sold, there was some 401k money in it, and so IRA 401k funds in that, and then the balance of the tenancy in common investors were all money out of their pockets, so tax money. So when the property sold, what we did is we peeled out all the qualified money, meaning the IRA 401k funds. That all went to those people, and they did what they did with that money. But for those people that wanted to be involved with the buy side, because this group does a lot of different things, and they were happy with the investment. So what we did is we did the exchange for the tenancy in common owners that wanted to go forward. We were doing an improvement exchange on the acquisition property. So by doing it, peeling out the qualified money and just completing the transaction for the money that had to be buried via 1031, it allowed a much smaller purchase to happen, and then the purchase was going to be an improvement exchange. So what we did is we took the IRA 401k money and used it for improvements of that replacement property. So we did the exchange for the group having to do the exchange. The IRA 401k funds went to the side. The purchase happens. We start going vertical on the project. So the IRA 401k money came back in via notes. And then when the project was, met the 1031 requirements, we conveyed the project back to our tenancy in common exchangors. Now, maybe a year or 2 years downstream, the lien holders, that money coming in via the qualified money, IRA 401k funds that was used for debt for the improvements, those notes were at a later date converted to a membership interest. So the TIC ended up contributing each member the property to this new LLC, receiving a membership interest attributable to their equity at that point in time. The qualified money came in via convertible note. Now you have all the TIC members and that retirement money all as members of this new LLC that owns the asset that's been completed at this point. Now going forward a few years now, today we're going the opposite direction on this. It's been ticked out again. So what I mean by that is this property went back from the LLC back to tenancy in common, and when it sells, the benefit of doing that is that each TIC member then has the ability to go buy what they want to do. If they want to pay taxes, they can pay the taxes. If they want to do another exchange, they can do that. And the qualified money, IRA 401k funds, they're just going to do what they're going to do too. But that's an example of combining, personal money and plan money into a common investment and working it out both sides of the transaction. I just love that. I think it's a great example of what is possible with planning. So this example is just another one where we're basically looking at a stack of capital, a stack of consideration being used to buy a property and what our client wants. So once again, we're representing the seller of a transaction. So we've got somebody that we represent actually on this transaction both sides. So the one client wanted to use the rental house as partial consideration to buy this apartment building. The total consideration for that apartment building, it was a $1 million deal. This was obviously a few years ago. So what happened is we had a $200,000 value on the house. We had a note, seller carryback of 120K, cash of 80,000 down, well, actually, I'm going to back up. So it's 200 for the house. The buyer, the person with that house, also had a note that was worth 120 that wanted to use that, and cash of 80, and then the seller, our client representing the buy side, that larger apartment building, was going to carry the note at 600. So really the seller carryback was short term by the buy side on it. And so at that point in time, we waited till that note converted to cash, and then we completed the transaction, got everybody where they wanted to go. And in this situation, that house was just kept by our client. So we didn't have to, actually stay on title to that. It went back to the seller of that larger property. So at the end of the day, they did another exchange and some other stuff, kept the $200,000 house. But what was interesting to me is the financing in this situation. The lenders were not wanting to do the deal with the house and that note. They didn't understand. They just looked at it as the only money being put down was the $80,000. So they weren't going to finance a purchase for our client that had that house they were using as consideration. So once again, this is just an example of what's possible given time to plan stuff out. You just don't want to do this deal at the 11th hour and then be dead in the water with no idea how we're going to accomplish your objectives in this transaction. So this is just an example of different items being used as consideration where it's not all a cash purchase. This is an ugly story. This is something I just put in here because we haven't seen these things start happening, but let's say that somebody's got a property that they are losing to a foreclosure or maybe selling on a short sale. And you think, well, how can I have gain? Remember at the beginning we talked about gain. Gain is simply the difference between the adjusted sales price and the basis on a property. If we look at a short sale or a foreclosure, the sale on that thing is the debt. Okay, so you're going to subtract the basis from the debt on the property, and that delta is called phantom gain. So it's a situation where on a primary residence, you've got some tax relief, income properties you don't. So it's really important. You think, well, gee, I lost everything. How can I have a tax hit? And that's sort of the ultimate slap is that you lose a thing, and now you've got tax exposure on that debt relief or depreciation recapture. That thing's coming in biting you. Okay, so understand in this situation, what happens is you've got a choice. You're going to lose everything and pay tax to do it, and that capital gains tax could be in excess of what you'd have to come out of pocket as far as the down payment on a replacement property. And since that debt is the quote unquote sales price, what you'd have to buy is whatever in value would be whatever the debt was on that relinquished property. But the choice is simple. I lose it, pay tax for losing it, or I come out of pocket, sometimes even less money than I would have had to pay in tax to go buy a replacement property or properties. And this is a process that we were working on for the last decade, cleaning up the last recession's mess. And I apologize. We talked about this slide already. I put the same slide in twice on this thing. Last example, this is a situation where this is a great opportunity where we had a broker that had a multifamily site that he had purchased the property, gone in, done the planning, the engineering, the permitting. It was all sort of ready to go. He had a client we were doing an exchange for, and so what we ended up doing is the broker sold to our exchanger on a seller carryback. It was a nothing down transaction. It was enough down to take care of the closing costs on it anyway. And basically what happened, the broker didn't have any tax consequence on that or very little, so he was fine. So then what happened is we bought the property and closed on it, put the EAT together, built the project out, and that broker that had owned the property previously, he wanted to be a partner in this project. So what we did is we used the cash that he would have normally received to get things in. He had that seller finance note that he had received. Instead of all the cash down, we had that cash preserved to go vertical on it, and that seller carryback was then going to be used after the project was completed. When the permanent financing was coming into play, the broker, we created a new limited liability company. Our client contributed the property. The broker, once again, like we gave that other example of with the qualified money on the acquisition side, in this situation, the broker that wanted to be part of this project then used that seller carryback, contributing it into that LLC, and he received a membership interest attributable to that. And now that project was owned by both the broker that owned the dirt initially and our client that built out the project. Now, once again, going forward, you have a situation where either the now entity, multi-member entity, legal partnership does an exchange, or you tick the thing out so that the, maybe our exchanger ultimately is now a tenants in common owner with the broker that put the thing together and worked on it. And then each party has the ability to either pay tax or move forward as they desire. That's the last example. And I hope those were interesting to you. If you've got questions on any of the information that we've covered today, please don't hesitate to ask. If you've got an idea on doing something and you want to sort of a sound wall, just to put it across somebody, give us a call, talk to us about it. We're happy to do that. We've got, as I said, IRA Advantage that handles retirement accounts, self-directed retirement accounts. We do IRAs, 401k plans, actually do business startups there. Post 1031's a property listing site, and then 1031exchange.com is where you all are today. So once again, David Moore, Equity Advantage. Thank you for joining us today. Please take a look at our YouTube channel. Like and subscribe if you like what's there. It really helps us out on that stuff. And I really look forward to working with you in the future. And thanks for your past business. And again, if you want credit hour for this presentation, reach out to Seymour at 1031exchange.com. Thank you again, David Moore, Equity Advantage, 1031exchange.com. All my best. Bye-bye.